What is your view? I mean, we've got inflation, which is slightly above 6%. We've got 30-year lows at 5.5%.
Yeah. So interest rates in real terms negative. There's a bit of a shock coming, I think, and that's to do with the recent increases in electricity and petrol and all that. And that will have a second round effect on inflation, all sort of things. And my view on inflation is quite negative. I think we're going to see inflation in excess and perhaps even well in excess of 6% throughout this year.
You're talking about the headline CPI number?
Yes, I'm just talking about the headline. But even if you look at the other numbers, if you look at the PPI, for instance, and sometimes you should look at the PPI, sometimes at the CPI. The CPI is a bigger basket, and the CPI has got a lot of services included as well. Remember, the PPI excludes services, and therefore the PPI is a much more volatile basket. But it doesn't matter. If you look, for instance, at the retail numbers, and you look at the underlying inflationary numbers in retail numbers or in the manufacturing numbers, you will see underlying inflation is there and is picking up and is likely to stay relatively high. So on interest rates front, obviously what needs to happen is that the Reserve Bank must start tightening. I'm not suggesting now. I think early next year, maybe the end of this year, but the interest rates are too low. But having said that, I am quite bullish. There's a good sign to this as well, because it allows you, with interest rates at a relatively low level, to adjust and to fix your balance sheets. And that's exactly what households are doing at the moment. Yeah. Your income, your wage income, is increasing at a stronger rate than the rate of increase in your debt burden. So the ratio between your debt and your income is actually falling. So that is debt to disposable income.
I mean, we're sitting exactly. At 75%.
It's still high, but it's coming down.
Yeah.
So debt servicing cost is relatively low. So households, they are fixing their balance sheets, and there's relative strong demand, and that is going to lead to stronger economic growth.
Okay, so let's just, I mean, off air we were looking at some numbers. So we're sitting at a 30-year low repo rate at 5.5%. Yeah. Prime lending rate is at 9%. Most people I know get, debt at around 12% if they want to finance a car or a house. Some at 13, 14, depending on your credit record.
Yeah. Or even up to 30%.
Yes, and unsecured lending, of course. This is a massive gap, Dawie. I mean, it's crazy when you look at what consumers are actually paying when you've got 30-year low interest rates. My question is, if we start to see interest rates rising by 1 or 2 or even 3%, I mean, obviously the overall rate of interest that we will be paying will be much higher. Can we afford this?
I'm not so sure that those very high interest rates that you are referring to, the 15, 20, 30s sort of percentage, are really directly related to the repo rate itself.
Yeah.
You should rather compare that to venture capital, because that's a sort of market that we're talking about here. If you look at the mortgage rate, for example, that is much closer related to the repo rate itself. And in fact, if you analyze mortgage demand in the economy, the demand, or in fact, the approvals for mortgages outstrips the actual take-up of new mortgages.
So mortgage interest rates are closer to repo?
That is closer, because that's a typical bank lending activity. It's a secured kind of risk. Banks do want to lend you money out against a mortgage in your house, because that's a secure kind of risk, but they're first going to lend you money and unsecured lending to you, because that's where the real margins are at the moment. So clearly that's the reason why banks are doing that.
Let's talk about the savings rates. It's also something you brought
to my
attention.
That is more importantly.
Absolutely. So, I mean, it's great because we pay quite a high interest for lending money, but to save money, we don't get such a great incentive.
Roughly about 5.5%, more or less. Money market rate around about 5.5%. If you're lucky, maybe close to 6% or so. And that's really the important one. South Africa's household savings is just positive. I mean, the past couple of years we were actually dis-saving. In fact, we were destroying capital in South Africa. If you're a dis-saver, you're a destroyer of capital, and we've just turned positive, and our savings levels are far too low. There are two main reasons, perhaps three reasons. One is we are just bad savers. We just don't know how to save. Maybe we have to go through an educational process, perhaps. But two very important macroeconomic reasons. Firstly, that the tax burden on potential savers is very high. And after you've paid tax, very little left to save. Secondly, the interest return that you get in savings is very, very low. So why should I save if I get nothing on that? So those are the two major macroeconomic reasons. If you want to improve the savings effort of households in South Africa, reduce their tax burden and increase short-term interest rates. And that's probably what's going to happen. In the short term, what we need to do, we have to have a very stimulatory, expansionary monetary
tax burden. I think we'll all be looking forward to that.
Well, no, so don't look forward to a reduced tax burden. That's not going to happen. I promise you that.
So just, are you talking about the short-term interest rates?
Yeah, I'm talking about so that's the only real alternative available to us. If we want to improve the short-term or savings, one of the things that we can do is to increase short-term interest rates.
Of course, we were talking to John Keynes a little earlier and Wayne McCurry. What are your views with regards to some of the comments that
Couple
they
of
made about
things.
the eurozone?
I'm much more bullish on the South African equity market than on American and the European equity markets, and the reason is because they've had a much stronger run than what we've had locally. So more bullish on local equities. I'm more bullish on the rand in the short term. I'm not talking about 2-3 years, but I won't be surprised if we see the rand around 7. Remember, it's not only a rand story, it's a dollar story as well. And I expect the dollar to keep on, or to remain under pressure for just about forever. Because, I mean, you can't just keep on printing money and expect your dollar or your currency to maintain its values. On the European situation, they simply cannot afford to allow the European experiment to disintegrate. And that's the reason why they threw so much resources at a very small, tiny economy like the Greeks. Because they cannot allow, if you allow the Greeks, or you allow Spain, which is having a bigger story, to default, it is a Lehman Brothers story. And see what happens just after Lehman Brothers. It's a much bigger story
Do you
than
think in
Lehman
hindsight
Brothers.
we should have bailed out Lehman Brothers?
Well, you know, I'm a bit of a free marketeer, and from a philosophical point of view, no. I think the right thing was...
Because you have to allow the market to re-rate itself.
You must
and
allow that,
readjust.
but I have to admit that it is a matter of too big to fail. Lehman Brothers was too big to fail. And part of the reason why it was too big to fail, because there are so many obstacles in the way of starting a bank, for example. So we must make it easier to start banks, have more banks, have more banks to fail.
Should make it easier for those that are, of course, defaulting on their debt, and when we bail out, they should be bailing us out too.
Who do?
Banks.
Banks.
Of course, but this is the problem, that taxpayers obviously bail out and assist when when trouble then comes, but we don't share in the profits and we don't benefit from the good times.
Well, the argument is going to be that if you don't bail them out, what's going to happen? The financial system is going to collapse, and you're going to need to lose the little that you do have. Of course, you've got a lot.
Yeah, absolutely. So do you. I hear that you've been buying Kruger Rands, Dawie.
No, I haven't been buying Kruger Rands. No. The only reason why I can think of buying Kruger Rands if you want to leave the country in a hurry.